guys, today we'll have an online video tutorial on FDNACCT, or Fundamentals on Accountancy, Business and Management, courtesy of BMS Academic Core Excellence Program, or ACE. So before we start on the lessons, I'll have a short introduction first. My name is Isabel Tantoy, and most people call me Isabel. My course is BSMGT, or Bachelor of Science in Business Management. The subject I'll be discussing today is FDNACCT, which is mostly about the basics of accounting. So here are the topics I will discuss in this video. First topic is the accounting equation, followed by the accounting cycle, and lastly, I'll give an overview on the financial statements. So first topic is the accounting equation. In this equation, assets equal to liabilities plus equity. This means that assets must always be equal to the liabilities and equity combined. If any two parts of the equation are known, then the third one can be determined. Also, it must always be remembered that all business transactions are recorded with this equation in mind. So moving on to the next topic, we have the accounting cycle. Shown on this slide are the 9 steps of the accounting cycle. I'll go through them one by one and briefly discuss each. So the first step is to analyze and classify transactions. In order to do this, we must first know which accounts are for credit and are for debit. So for asset accounts such as cash and accounts receivable, the normal balance is debit and a decrease in the account is credit. For liability accounts such as accounts payable and notes payable, the normal balance is credit and a decrease in the account is debit. For equity accounts, the normal balance is credit and a decrease in the account is debit. Always remember that a debit is recorded on the left side of an account and a credit is recorded on the right side of an account. So now that we have identified which accounts are for debit and credit, here is an example. On December 10, 2020, Anna bought 25 pieces of paper from the nearby store, Paper & Co. This cost her 30 pesos and she paid the exact amount in cash. So the accounts here will be cash to represent Anna's payment and sales for the income received by Paper & Co. So we will debit the cash account for 30 pesos and we will credit the sales account for 30 pesos. Second step is to journalize transactions. In this step, we will record the transactions in the general journal, which is the book of original entry. It records all transactions of a business in chronological order. Here is the format of a journal entry. As always, debit is on the left and credit is on the right. Using our previous problem, here's an example of a journal entry. Debit is always written first, which is why we have cash in the first column, followed by sales. Third step is to post transactions in the ledger. A ledger is the record of final entry. It contains the cumulative balances of each account. Posting transactions in the ledger means that we are transferring the journal entries to the ledger. T accounts represent the amount in the ledger. So below is the format of a T account. Based on its name, it is shaped like a letter T, and the accounts to be debited are written on the left, while those to be credited are written on the right. So next step is to prepare a worksheet. This is helpful for the next step, which is preparing the financial statements. Through a worksheet, we can already see the final balances of the accounts needed in the income statement and balance sheet, or SFP. Below is the example of a worksheet. So as you can see, the last columns here are labeled income statement and balance sheet because the final balances here, we can transfer them or we can use them to write the financial statements. So the fifth step is to prepare the financial statements. Statements to be discussed today are statement of profit and loss or income statement, statement of changes in owner's equity, statement of financial position or balance sheet, and statement of cash flows. I will give a more detailed explanation of these statements on the next topic. So sixth step is to journalize adjusting entries. Adjusting entries are adjustments made at the end of the accounting period in order to allocate income and expenditure to the period where they occurred. This is considered as the accrual basis of accounting. Next step is to journalize closing entries. Permanent or real accounts are accounts whose amounts are carried over to the next accounting period, while temporary or nominal accounts are those who are closed every accounting period. Through journalizing entries, we transfer or close nominal accounts to real accounts. So eighth step is to prepare a post-closing trial balance. In this step, we list all balance sheet accounts with a non-zero balance and verify that all debits are equal to credits. Note that it is done only after the closing entries. Last step is to evaluate and communicate financial information. This is done in order to aid business leaders in decision-making. So for the last topic, we have the overview on the financial statements. So the first statement to be discussed is the statement of profit and loss or income statement. This is the first financial statement to be done, and it states the revenue, expenses, together with the net income or loss. Revenue is defined to be the inflow of cash from sales or provision of service, and expenses are the outflow of cash due to costs incurred. The natural format lists all the revenues and expenses together, while the functional format categorizes the expenses into two, the general and administrative expenses and selling expenses. General expenses are those incurred on the day-to-day operations such as utilities. On the other hand, selling expenses are those used by the company for the distribution of their products or service, such as marketing expenses. So shown in this slide is an example of the two formats. On the left is the natural form. As you can see, revenues and expenses are listed together. On the right side is the functional form. Expenses are categorized into operating and other income and expenses, wherein operating is further classified into selling and general expenses. So next is the statement of changes in equity. This reports the changes in the owner's equity account caused by contributions, withdrawal, and net income or loss. This is usually done after the income statement. The final amount in this statement is transferred to the statement of financial position. So here is an example of a statement of changes in owner's equity. Starting with the beginning capital, additions and net income is added, followed by subtracting the owner's withdrawals. The net increase or decrease in equity is then applied to the ending capital, which is transferred to the balance sheet. So the next statement is the statement of financial position or the balance sheet. It reports the financial position of a company at a certain period. It contains the asset, liability, and equity accounts. There are two formats, the report form and the account form. So shown on the slide is a sample format of an SFP in report form. In this, all accounts are written in one straight list. Now on this slide is a sample of an SFP in account form. In the account form, assets are written on the left side, while liabilities and equity are written on the right. To understand SFP more, I'll shortly discuss the three accounts. Assets are properties owned by the business. It can be classified into two, current and non-current assets. Examples of current assets are cash, accounts receivable, notes receivable, inventory, and prepaid expenses. Examples of non-current are property, plant, and equipment, and investment in trading securities. Liabilities are obligations or debts of the business. Examples of current liabilities are accounts payable, notes payable, accrued expenses, and unearned income. Examples of non-current liabilities are long-term liabilities such as bank loans. So last is equity. It is considered as the company's net worth. We can take this by subtracting liabilities from the assets. It is composed of the owner's investments and their accumulated net income, and it is known as the capital of the business. So last statement is the statement of cash flows. This reports the net cash flows based on 3 activities: operating, investing, and financing. The statement of cash flows can be composed in by two methods, the direct and the indirect. So here's the sample format of the two. The direct method subtracts outflow of cash from inflow to get the net cash flow from operating activities. In the indirect method, we get the net income and subtract outflow and add the inflow of cash in order to get the net cash flow from operating activities. This is the only difference of the two methods. So this ends our video tutorial. I hope you guys learned something from me. Thank you for listening, and I wish you good luck on your finals.